Hi guys, I hope you can hear me. I'll wait for some time for all of you to join in. Sorry for the delay, there was a technical issue. Hi Aditya. Okay, so I think we've reached a benchmark of 50 and then we can start off our... Okay, so good afternoon first of all, and this is the first time you guys are seeing me live. So let's quickly do our capital gains revision today. Now, first of all, let us understand the structure of the entire chapter, and we will not be discussing every provision in detail, but yes, as and when we come across something important, I will emphasize on that. At the same time, I don't want you guys to spend a lot of time typing hi sir, bye sir. Just try listening. Okay, that's more important. And we'll reserve the last 10 minutes for your questions, or 10-20 minutes for your questions. That's not an issue at all. I have enough time, thanks to it being a Sunday, and on top of that, it being a curfew day. So first of all, when we say capital gains, what is the charging section? Of course, section 45. And in section 45, what have we learned? We said if there is a transfer of a capital asset which has been effected during the previous year, and very important, we need to learn what is a capital asset. Of course, this has been discussed. You need to know what is a capital asset. You need to know the definition of transfer, and of course, you already know the definition of previous year. Now, let me just read through it. As far as definition of capital asset is concerned, we know it is in section 2, clause 14. You must remember that it excludes certain items, especially the fact that it excludes personal effects. But remember, personal effects excludes certain articles of jewelry, drawings, sculptures, archaeological collections, etc., etc. As far as what is rural agricultural land, you must know the 2 kilometers, 6 kilometers, and 8 kilometers. Very important for you. Going forward, as far as transfer is concerned, section 2, clause 47. We discussed this in detail during our class, but you need to know in detail what is the definition, because they might ask you. The definition must be for 2 marks or 3 marks, and you must be ready for it. Next, once you know what is a transfer, you also need to know those transactions which are not treated as transfer. And where is this covered? This is covered in section 46 and section 47. Yes or no? So as far as section 46 is concerned, we learned when there is a company in liquidation, what happens when the company is in liquidation and the assets are transferred by the company in the process of liquidation to the shareholders thereof. Then will it be treated as transfer in the hands of the company? No, it will not be treated as transfer in the hands of the company. However, will it be treated as transfer in the hands of the shareholders? Of course, yes. Having said that, please understand, when the shareholder further transfers this asset, what will be taken as the cost of acquisition? The cost of acquisition will be taken as the fair market value as on the rate of liquidation or the distribution. Next, section 47 contains all those transactions which are not to be treated as transfer. So we've learned any distribution of capital assets on partial or complete partition of a Hindu undivided family by way of gift, will, or irrevocable trust. Now, whenever we talk about this gift, will, or irrevocable trust, now please remember, any question on gift, will, or irrevocable trust, please think from different angles. Don't only think from capital gains perspective. Remember, whenever we talk about a gift, there is a person who is gifting. Let me call him as the donor, or the person who is gifting, and the receiver, the donee. Now, in the hands of the donor, what I'm trying to tell you, it is not to be treated as a transfer. But in the hands of the receiver, correct? In the hands of the receiver, you must check not only the provisions of capital gains, the provisions of income from other sources. We have done in the class section 56 to 10. So let us say Mr. A is gifting an immovable property, let's say a building, to Mr. B. Correct? If Mr. B is the receiver here and Mr. B is a relative or Mr. A is a relative, then 56:10 does not apply. But if not a relative, then remember 56:10 applies, and we have to check those benchmark limits at 50,000 ka limit. If it is greater than 50,000, you have to take it as income from other sources. Now, very important, they might ask you in the hands of the receiver, what will be treated as cost of acquisition if this receiver further transfers the asset. In such a scenario, remember, if the transaction is not subject to 56:10, then in the hands of the receiver, the cost of acquisition is the cost of the previous owner. Just to give you an example, let us say my father gifted me a building. Now remember, when I receive a building from my father, there is no question of me paying income tax by treating the stamp duty value as income from other sources. It is not subject to 56:10. Correct? In such scenario, what is the cost of acquisition for me when I further transfer the asset? It is the cost to the previous owner. But let us say one of my client or some friend of mine gives me a building as a gift. Now in my hands, because this transaction is subjected to 56:10, the cost of acquisition will be taken as the fair market value or the stamp duty value which I have taken for the purposes of 56:10. Just to give you an example there, let us say the stamp duty value of the building that was gifted to me is 10 lakhs. And this happened during the previous year, 1920. Now in 1920, this 10 lakhs is treated as income from other sources, well and good. But let's say 2 years later, I sold this building for 30 lakhs. Of course, in that year, I have to calculate capital gains. Sale consideration is 30 lakhs. But then what is the cost of acquisition? The cost of acquisition is the fair market value taken for the purposes of section 56:10. Of course, going forward, the other transactions which are not to be treated as transfer, we learned transfer by holding to subsidiary, subsidiary to holding in the process of amalgamation by the amalgamating company to the amalgamated company. Of course, remember there are certain conditions and all the other transactions. Now here I would like to emphasize a little on reverse mortgage. Okay. Now, as far as reverse mortgage is concerned, remember reverse mortgage is not to be treated as a transfer. Now, a lot of you have messaged me personally, what is this reverse mortgage? We couldn't understand completely. Now, let us understand this very simple and straightforward. If I go to the bank, correct, and let us say I have a house, and this house I'm ready to mortgage with the bank, and the bank in turn agrees to pay me not a lump sum amount, but just 50,000 rupees per month, must be every month and month and month till the time I die. So what have I done? I have mortgaged my house to the banker, and what is the banker doing? He's paying me 50,000 rupees per month. Now this transaction is called as a transaction of reverse mortgage. Now is it treated as a transfer? It is not treated as transfer. But some of you have come to me and said, sir, what if the loan is not paid? Now remember, actually speaking, in the transaction of reverse mortgage, generally, this is done by old people. So when the old man expires, so the banker actually gives two options to the legal heir. Option number one, Baba, the outstanding principal plus interest is, let's say, 20 lakhs. So you clear this 20 lakhs and you take the property and go. Very good. Option two, we will sell the property in the open market, let's say for 50 lakhs. Anyways, 20 lakhs is due to us, so we will return back your 30 lakhs. Now, in both these circumstances, let us understand what is the impact. Now, in the first scenario, I told you, the banker is telling the legal heir, please pay 20 lakhs and take back the property that your father has given as mortgage. And in this circumstance, there is no transfer at all. There is no transfer at all. But now I want to ask you a very important question. Now, can this legal heir who's paying a 20 lakhs to clear the title from the bank take this 20 lakhs paid to the banker as cost of improvement? The answer is yes. This 20 lakhs that has been paid by the legal heir to the banker in order to clear the title and get the title of the property that his father has given. Remember, his father has given the house, but with a small teda in title. To clear that mortgage on the title, he is paying 20 more lakhs. So 20 lakhs can actually be treated as cost of improvement by the legal heir. So when the legal heir is selling it, let us say later on, the legal heir sells the house for 1 crore. So sale consideration 1 crore minus cost of acquisition is the cost to the previous owner. Remember, he got it by way of will. And our cost of improvement is that 20 lakhs that he has paid to the banker. Remember, this 20 lakhs can be taken as cost of improvement. Acha, in the second scenario, what if the banker says, I will only sell it in the market for 50 lakhs, I will auction it in the market for 50 lakhs, I will take 20 lakhs and return the 30 lakhs to you. This will also be treated as transfer. But if the 20 lakhs is paid by the legal heir to the banker gives back the property to the legal heir. There is no question of transfer. I hope you understood clearly whatever it is. Acha, going forward, as far as reverse mortgage is concerned, that was one thing I wanted to explain to you. The other thing that I wanted to explain or emphasize and discuss was conversions. Now, in section 47, 13, 13b and 14, we've learned conversion of sole proprietary, conversion of company to LLP, conversion of firm to... In all this, remember, there are certain conditions. And if in the exam they give you any of this and they ask you, is it treated as transfer? Please check for each of the conditions. I have made it in a tabular format for you. I don't think you can see it. Anyways, it is in a tabular format in your notes which you can download. And you have to check whether each of the conditions is satisfied. Only if it is satisfied, then the transaction, that the process of transferring the assets in the process of conversion shall not be treated as transfer. Going forward, next, as far as section 46 and 47 is concerned, that's fine. Also, remember 47A. Now, there are certain provisions in section 47 wherein we have learned that some conditions need to be satisfied even after the transaction takes place. For example, in 47.3 and 47.4, we said the asset should not be transferred for a period of 8 years. Correct or not? So, if these conditions are not satisfied, then section 47A comes into picture. What is section 47A? Section 47A says those transactions which were earlier not treated as transfer will now be treated as transfer. Will now be treated as transfer means now you will compute capital gains in the year of violation. Next, as far as section 48 is concerned, which is our main computation section, computation is quite simple and straightforward. Now, remember, any problem that comes in the exam, you have to first understand what they are asking you. And I've been telling this multiple times, even through the course of recording. Lot of the students, it's not the fact that they don't have knowledge to pass the exam, it's the fact that they don't read the question. They will be asking something, you will be computing something else. Okay, so if they ask you whether to tell if it's a transfer, stop there only. Tell if it's a transfer or not a transfer and stop there. If they ask you to do the computation, do the computation. And whenever you do computation, please remember, it's very important for you to give a conclusion, whether it's long term, whether it's short term. Next, if they say find out the tax thereon, then go ahead and apply the rates of tax. Correct or not? Anyways, as far as computation is concerned, section 48, what is the basic sale consideration minus expenses on transfer? Gives you the net sale consideration minus cost of acquisition minus cost of improvement, and that gives your capital gains. Very simple. Now, what is the expenses on transfer? Those expenses which are directly attributable towards the transfer of the asset. Of course, sometimes you might get confused between expenses on transfer and cost of improvement. Let me just give you a small example. Let us say I have a flat in Bangalore. Correct? Now, I wanted to sell this flat for, let's say, 30 lakhs. Now, obviously, whenever you want to sell your property, you want it to look good. So what I have done before I sold the flat, I got it painted. I got it painted, and then I said, okay, on painting 10,000 rupees is the expenditure. Now, is this painting expenditure cost of improvement, or is it to be treated as expenses on transfer? Now, one thing you remember, whether it is expenses on transfer or whether it is cost of improvement, ultimately it is a deduction from the sale consideration. Having said that, you tell me, is such an expenditure directly attributable to the sale? We can answer it in two ways. Was such an expenditure required for the transfer to be made? Is it required for painting to be done? Not required. Of course, you wanted a better value. You wanted a better value means you are improving the value. That means it is to be taken as cost of improvement. Anyways, so bifurcation is only for our understanding. You only think, is it attributable towards the transfer? If you are improving it, you are painting it and improving it, correct, then you can take it as cost of improvement. Anyways, even if you are mistaken between these two, not a great thing, because the answer will not change. Having said that, the provisos under section 48 are very important. Now, we have discussed each of these provisos in the class, and something that you guys want in the provisos, if you can tell me, I will discuss first, second. Now, someone is asking, how do you find out whether the capital gains is long term or short term? Beta, pura Ramayan hone ke baad, who is Ram, you're asking. Anyways, so it's given very clearly in section 2, class 42A. We have 36 months, 24 months, and 12 months. So I don't want to confuse you right now, but if you go through the provisions, very clear. Remember where to apply 12 months, where to apply 24 months, where to apply 36 months. Anyways, going forward, in the explanation, which is there, very good. Someone is asking Manjula Jesha case law. So let me just first finish explanation 1. So in explanation 1, which is there under section 2, clause 42A, it talks about whether or not the period of holding should be included or not. Before I come to this, let me first discuss this Manjula Jesha case law. Now, let us say my father purchased an asset in the year 2000. He purchased one building. He gifted that asset to me 2 months back. He gifted that asset to me 2 months back. And I sold the asset immediately today. Achha. Now I want to know whether my period of holding, why is period of holding so important? Period of holding is important to ascertain whether it is long term or short term. I want to know what is the period of holding. I want to know whether period of holding is from the time the asset was first held by the current owner, because the law says so. The law says you should only take it from the time the asset was first held by the current owner till the date of transfer, or 1 day prior to the date of transfer, if I have to be very specific. Correct? Actually speaking, the law says only so much. But what does the case law say? The case law, the court said the period of holding includes the period of holding of the previous owner also, which means my father bought it in 2000. He gifted it to me, and because I got it by way of gift, correct, the period of holding for me will include the period of holding by the previous owner also. So that is Manjula Jesha. Anyways, sir, do we need to quote the sections? Remember, sections not so important from your exam perspective to quote them, but let me tell you this. See, there are two ways I can say or discuss the provisions of law in the exam. And nowadays, there's a trend of the ICAI asking questions by saying, briefly discuss with provisions of law. First, if I quote the section, the examiner understands that I very well know the law. Okay. So if, for example, if I say as per section 32, examiner already knows I'm talking something about depreciation in the provisions of PGPP. There is something that is there which I am asserting. However, if I don't know, no problem. I can still say as per the provisions of PGPP. I can still say as per the provisions. Or I can rewrite the law. For example, like we were discussing just a cost of the current owner is cost to the previous owner. If I know, I can say as per section 49 subsection 1, the cost of acquisition is so and so. Suppose I don't know section 49 subsection 1, but I know what section 49 subsection 1 tells us. So I can say as per the provisions of capital gains, in case where the asset has been received by way of gift, the cost to the current owner is equal to cost to the previous owner. So it's not so important to quote the sections. So don't ask me, are there any changes? Of course, there are changes and there are amendments discussed at various places. Okay, going forward, as far as explanation 1, it talks about whether period of holding should be included or not. Then the provisos to section 48 have been discussed. Next, secondary charging sections. Now remember, section 45 subsection 1 is not the only charging section of capital gains. Section 45 subsection, what does it say? It says if there's a transfer of a capital asset effected during the previous year, then we know it is capital gains will compute. But the other, for example, section 45 subsection 1a, what did we learn here? If there is a function of nature like flood, typhoon, hurricane, riot or civil disturbance, accidental fire or explosion, action taken by an enemy or action taken in combating an enemy, then what happens? Will you take the capital gains to be in the year in which such a damage or destruction has taken place, or will you take it in the year in which insurance compensation is received? Obviously, in the year in which insurance compensation is received. Similarly, section 45, subsection 2, conversion of capital asset. All of this we have discussed in detail. No worries. Any doubts relating to section 45, other charging sections that you want me to discuss? Unexhausted basic exemption, I will discuss in detail. Don't worry. Anything in section 45, the secondary charging sections that you want me to discuss? Where asset has been transferred by a partner to the firm, what happens? You have to take it as it's recorded in the firm. When it is the other way around, when there is a dissolution of the firm, then the fair market value. Okay, as far as the secondary charge, by the way, one very important thing. Some of you wanted me to discuss about the joint development agreements. Correct. So let me tell you what is the problem and how it was solved or partially solved. Now earlier, let us say I am the landowner, correct, and a builder comes to me, and we are right now in the financial year 1920. So this is not applicable today. Let me go 5 years back. Let us say some 14. I do construction services. We make one building, and वो building में आधा आपका आधा मेरा, half yours, half mine. Joint development agreement. What was happening? What was happening is the provisions of section 53A of Transfer of Properties Act used to get retracted. Section 2 clause 47 said transfer includes section 53A of Transfer of Properties Act, meaning to say if there is an agreement, consideration is determined and possession is transferred, if these three conditions are satisfied, then there is a transfer. So in a joint development agreement, all these three conditions are satisfied, there is an agreement. Consideration is determined, half the building, baad mein I'll get, must be after 3 years, after 4 years, after 5 years, if the project gets over. Possession, of course, you're handing over possession. That is how he's actually starting to do the construction. So capital gains was getting attracted. Income tax department immediately used to send a notice saying what, please pay the tax. Kya baat hai? So are you saying income tax department was actually collecting tax even before that person actually got any part of the built up area in the joint development agreement? Yes, that was the problem. So what have they done now? Now, very simple and straightforward. They have said for an individual and a HUF. Remember, the problem is only partly sorted, not fully solved. Why not fully solved? Today also the problem is there for other than individual and HUF. And yes, let's talk about individual and HUF. For an individual and HUF who is getting into a joint development agreement, the capital gains will arise in which year? Is it in the year in which the contract is signed? The joint development agreement is signed? No, it is not in that year. It is in the year in which the completion certificate has been issued by a prescribed authority. Very simple and straightforward. Of course, If as a part and parcel of the joint development agreement, there is certain amount of non-refundable consideration that is being received, that non-refundable consideration will be taxed in the year of receipt itself. Yes, going forward, so that's about section 45, subsection 5a. Next, as far as section 55 is concerned, definitions, cost of improvement. Now here, there is something very important I have to tell you. In section 55, subsection 1, clause B, we have learned, in case of goodwill of business, right to manufacture, produce or process any article or thing, right to carry on any business, the cost of improvement shall be taken as nil. 3 assets. Similarly, in section 55, subsection 2, clause A, we have learned for 8 assets. What are the 8 assets? Goodwill of a business, trademark, brand name, right to manufacture, produce, process any article or thing, right to right to carry on business or profession, tenancy rights, stage carriage permits, and doom hours. The cost of acquisition shall be taken as nil. Now, let me explain something interesting. Here he says, goodwill of a business, the cost of acquisition shall be taken as nil. Now, what does this mean? Let us say I am running a garment factory. I have got one brand name called Color Code. Okay, and I have run this business for 10 years. At the end of 10th year, I've decided I don't want to do the business. I shut down the plant. Everything I shut down. Only thing that is left with me is the brand name or goodwill called Color Code. Now, this Color Code brand has some value in the market. People recognize it. So what I did, I sold this brand. I sold the goodwill of this business for 10 lakhs. Compute capital gains. Sale consideration 10 lakhs minus cost of acquisition 0. The cost of acquisition for such goodwill, all these 8 assets that are mentioned here shall be taken as 0. Going forward, as far as the option to take the actual cost of acquisition or the fair market value as exists on 1/4/2001, let's see what he says. Now, whenever in the question it tells or you get any scenario where the asset has been acquired either by the current owner or in cases where it is falling under section 49 subsection 1, even by the previous owner, the asset was acquired prior to 1/4/2001, you have an option. What is the option? Take at your option the cost of acquisition or the fair market value as on 1/4/2001, whichever is higher. Whichever is higher, you have an option. So you can now, a lot of you, especially because when I was conducting tests, I see, let us say the actual cost of acquisition is 70,000 and the fair market value as on 1/4/2001 is 30,000. You go and take 30,000. No, the law does not say you should take the fair market value as on 1/4/2001. The law gives you an option. So be very careful. Deepak says, please discuss about computation of cost of acquisition of unlisted shares. In what scenario? Cost of acquisition of unlisted shares is at the price at which you have bought. Please be a little specific. As far as section 49 is concerned, subsection 1, in certain scenarios, how you take the cost of acquisition of the current owner to be the cost of acquisition of the previous owner. In all other sections there, the cost of the asset is nothing but the cost of the asset from which the original asset has arisen. Let us discuss a little about capital gains in case of depreciable assets. And a lot of times I find students are not so clear about this. Now, as far as depreciable assets are concerned, please understand, as far as income tax is concerned, we follow the block of assets concept generally. However, in case of power units, correct, you have an option to follow SLM also. So let's keep SLM for the timing aside, let's discuss about WDV. How do you compute the written down value? Opening WDV in the year in which the business commences is 0. Additions, number of assets, amount, minus sale proceeds from assets sold, disposed, and then you get your closing WDV. Now let me ask you one important thing. Let us say this is the first year of my business and I have bought 2 cars for 50 lakhs in total. So 2 cars for 50 lakhs, and I have sold 1 car, the same year I have sold 1 car for 50 lakhs. What is my closing WDV? Very simple and straightforward. My closing WDV is 0. Acha. Now, if I re-ask this question in a different manner, I have bought 2 cars, each costing 25 lakhs, and I have sold one of those cars for 50 lakhs. What is the closing WDV? 0. What is the capital gains? There is no capital gains. Why there is no capital gains? Please understand, in case of depreciable assets, capital gains arises only in 2 scenarios. And when I say capital gains, it includes losses. It arises only in 2 scenarios. First scenario, the sale proceeds is greater than the opening WDV plus the additions made during the year. Now here sale proceeds is 50, opening plus additions is also 50, therefore not satisfied. Second scenario, when the entire block is sold, then you'll have a loss. So in this particular scenario where I bought 2 cars for 50 lakhs and sold 1 car for 50 lakhs, there's no capital gains, there's no capital loss. But it might still not settle in for you. So, but what happened? 25 lakhs ka profit kidhar gaya? There is no capital gains. End of story. There is no question of capital. Then there's no capital gains. Forget it. Don't try to confuse your accounting concepts with your taxation concepts. Anyways, coming back. One more example. Let us say I bought 2 cars for 25 lakhs each, which is 50 lakhs. And I sold 1 car for 60 lakhs. Acha, in this case, capital gains will come. Why? Sale consideration is greater than the actual. Sale consideration is greater than the opening WDV plus the additions made. Similarly, let us say I bought 2 cars for 50 lakhs and sold both the cars during the year for 30 lakhs. In this scenario also capital loss will arise. Why? Because you had only 2 assets in the block and you sold both the assets. That means you'll have a capital loss to the tune, of course, order 50 lakhs you bought, 30 lakhs you sold, so 20 lakhs ka capital loss. And remember, as far as depreciable assets are concerned, it's always short term. There is no question of long term capital gains or long term capital loss. It's only short term capital gains, short term capital loss. For the purposes of section 48, that means for computation purpose, it is going to be only short term. Acha. Someone is asking something important. He says, sir, if bonus shares are acquired before 1/4/2001, is the concept of cost or fair market value at the option of the SEC? Absolutely. Bonus shares, now think about it, bonus shares, the actual cost of acquisition is 0. So let us say Reliance Industries declared bonus shares in the year 1995. Oh, so very simple. Either you take the actual cost of acquisition, which is 0, or the fair market value as on 1/4/2001. So that answers your question. That option is available. Sir, SSE is non-resident and bought shares, debentures, and such assets were acquired from foreign currency and currency rate fluctuates. इसमें confusion हो जाता है. What is the confusion there? What is your doubt? Please be a little more clear. Anyways, coming back. So that's about the capital gains on depreciable assets, especially when WDV is follows. As far as straight line method, I think I've told you multiple times how to compute capital gains if SLM method is followed. So you know the concept of balancing charge, you know the concept of terminal depreciation, and that's more than enough. And you know the concept of capital gains. When does capital gains arise? If you're following straight line method, only if you have sold the asset for greater than the actual cost of acquisition. Let me take an example. Let us say a power unit who's following straight line method purchases an asset for 10 lakhs. Let us say rate of depreciation is 10%. So over 3 years, 10 lakhs mein 1 lakh, 1 lakh, 1 lakh. What is the unamortized or undepreciated value or book value? 7 lakhs. If the asset is sold for 8.5, there is no question of capital gains. Why? It's only balancing charge. If the asset is sold for 10.5 lakhs, that means it is over and above the actual cost of acquisition, then only capital gains will arise. And how do you compute capital gains? Very simple. Sale consideration, which is 10.5 lakhs, minus the original cost of acquisition, which is 10 lakhs. Sir, could you please make a video on deductions from 80C to 80U? Please go through the videos. I have already made videos in respect of 80C to 80U. Don't ask questions relating to other chapters right now. Going forward, as far as slump sale is concerned, section 50B. Now, what is a slump sale? Very important for us to identify if a transaction is a transaction of slump sale or not. Because sometimes they might not mention it in the question. They might simply give you a scenario. X Limited has sold the division as is, where is basis all the assets and liabilities have been transferred. Remember, the bottom line for a transaction to be called as a slump sale is that all the assets and liabilities relating to that division, relating to that undertaking are transferred without bifurcating the sale consideration. Without bifurcating the sale consideration. Same question if they say X Limited has transferred its paints division. For land, they have said 30 lakhs. For building, 10 lakhs. For plant and machinery, 50 lakhs. For debtors, 30 lakhs. They are bifurcating consideration. It is not a slump sale. If the consideration is not bifurcated, only then it can be called as a slump sale. And remember one thing. Suppose there is bifurcation of consideration for the purpose of registration. Now, let us say a school was sold for 30 crores. A school means undertaking was sold for 30 crores. But remember, when you sell an undertaking, obviously if the undertaking has some immovable property, don't you think the vendor and vendee should go to the registration office and sign? Yes. Acha. So what they've done, they went to the registration office, the vendor and vendee, and they wrote land sold for 10 crores. Oh, that means the consideration was bifurcated. Oh, don't worry. If the consideration is bifurcated only for the purpose of registration of the immovable property, it will still remain to be called as a slump sale. Going forward, section 50C, you know very well. Now, again, let me just repeat one very important part in section 50C. What is section 50C? Section 50C says where there's a transfer of an immovable property and the consideration is less than the stamp duty value, then for the purposes of computation of capital gain, the stamp duty value shall be taken as the sale consideration. Very good. So I sold a land only for 30 lakhs, but stamp duty value is 50 lakhs. So for the purpose of computation, what will you take? You will take the stamp duty value because it's higher than the actual consideration. But what if way back in 1995, I entered into an agreement for sale. That means way back in 1995, I agreed to transfer that land for 30 lakhs. That agreement also is there. And in 2019, that fellow paid the 30 lakhs to me. Or paid that 25 lakhs he paid long time back, 25 lakhs he paid now, and therefore I got it registered today. Acha, agreement for sale happened long time back, sale deed is happening today, registration is happening today. Which stamp duty value will you take? Will you take the stamp duty value which is existing as of today, that is 50 lakhs, or will you take the stamp duty value as existing so many years back in 1995? The answer to that question is very simple. The answer to the question is, when you entered into an agreement for sale long time back, did you receive any consideration in a mode other than by way of cash? Did you receive any consideration by account pay check or account pay draft? Did you? If yes, if that 5 lakhs was received long time back in 1995 at the time or before the time of entering into agreement for sale, then I will take the stamp duty value as existing on that particular date. Otherwise what? Otherwise, I will take the stamp duty value as existing as of today. Amendment of 105% of sale consideration of fair market value. Please explain. I will explain. Now, in this example which I just did, it says I sold for 30, but the stamp duty value is 50. What if I sold for 30, but the stamp duty value is 31 lakhs? Oh, please understand, sometimes there needs to be a moderation. Matlab, sometimes the actual consideration could be in and around the stamp duty value. In such scenario, what does the law say? The law says, please check if it is falling within the 5% cushion. So, because it is only 31 lakhs, check 5% of 30 lakhs. If it's falling within that 5% cushion, then what will you take? Will you take 31 or will you take 30? You will take the actual sale consideration itself. You will not consider the stamp duty value. Part of the payment before registration means how much, sir? Is 1 rupee also sufficient? Absolutely. On the strict reading of the law, Dilip Kumar, even 1 rupee is sufficient. Yes, even 1 rupee is sufficient. 1 rupee through account paycheck he paid in 1995. Baki ka 29 lakhs, 99,000 he paid today. Then I will take the stamp duty value as existing in 1995. But remember, the intention of legislature is to take genuine cases. You tell me, in 1995, if you received 1 rupee, will you wait for 25 years to receive the remaining 29 lakhs, 99,999? Up to you. Anyways. Situation in which indexation benefit is not available, also section 112. Okay. Now, as far as those scenarios in which indexation benefit is not available, we learned. Now, as far as first proviso is concerned, we know indexation is not available under section 48. What is the first proviso in case of non-resident who transfers securities? Remember? Second proviso, we learned bonds and debentures indexation is not available. Right? So, third, we learned in slum sale indexation is not available. So I think for IPCC, for C intermediate, these are the scenarios. If you come across anything else, please let me know. If the stamp duty value is more than 105%, we must. Yeah, if it's not falling within the 5% cushion, then you have to consider the stamp duty value itself. Next, going forward, section 51, very important, advance money received. Now, section 51 we have to discuss along with section 56 to 9. Now, listen very carefully. Actually speaking, section 51 does not have much of relevance today. Why? Because section 56 to 9 today very clearly says if there is any amount that is forfeited, then in the year of forfeiture, it will get taxed. So let me take one example. I wanted to sell my flat in Bangalore. Okay. I called the agency guy. He showed it to a customer. The customer was very excited. He gave me 1 lakh rupee advance today. And I said, thank you. Bakika, you transfer within 7 days. I'll transfer the asset to you. In 7 days, he did not get back to me. So what I did, that 1 lakh that he paid me, I forfeited. Acha, that 1 lakh which he paid me, I forfeited. Now tell me, as of today, what are the provisions of law? The provisions as of law today are section 56 to 9 says that 1 lakh rupees because you have received it during the previous year 1920, it will be taxed in the previous year 1920, that is assessment year 2021. But let us say this happened somewhere in 2013. Suppose in 2013, 1 lakh rupees was received and I have forfeited. That time, this section 56 to 9 was not there. But let us say, if it was not there, that means that 1 lakh never got taxed earlier. Let us say today I sold that flat for 30 lakhs. What am I supposed to do? 30 lakhs is sale consideration minus cost of acquisition. Let us say I originally bought the flat for 10 lakhs. 10 lakhs, my cost of acquisition minus 1 lakh, which I forfeited in 2013. 9 lakhs into, of course, cost inflation index of the year of transfer minus cost inflation divided by cost inflation index of the year of acquisition. Now remember, there are few authors who say that after taking indexation benefit, you should reduce the 1 lakh. But I am with ICAI on this. The law is very clear. The law says the cost of acquisition should be adjusted Okay, and even if you see the illustrations given by ICA, this 1 lakh is adjusted before indexation benefit. So let's not get confused there. Determination of acquisition value for property inherited in 1975. Very good. Now, let me discuss on that. Let us say I have received an asset from my grandfather. My grandfather, let us say, got the asset way back in 1950s or something. He gave it to my father in 1975. My father gave it to me in 2000. I sold it today. The logical explanation is very simple. Cost to the current owner is cost to the previous owner, my father. Cost to the previous owner is cost to previous owner, my grandfather. My grandfather, if I have the papers, then I will see and I will compare it to the fair market value as existing on 1/4/2001. And I'm assuming the fair market value as on 1/4/2001 will be higher, and therefore I will take the fair market value as on 1/4/2001. So if in 1975 the cost was higher, then of course I'll take that cost. What circumstances valuation officer is approached to ascertain the value? Now, please remember in sections like section 50CA, section 50C, where the stamp duty value is greater than the actual consideration, the stamp duty value has to be taken as the sale consideration for the purposes of computation. However, the SSE is put at hardship here. Think about it. I actually received only 30 lakhs. Let us say it's a genuine scenario. I actually received 30 lakhs and the stamp duty value is 50 lakhs. So what can I do? I can actually go to the assessing officer and I can tell him, sir, this property really I sold for 30 lakhs. Why don't you appoint a valuation officer? In such a scenario where the SSE claims that the stamp duty value is greater than the fair market value, the assessing officer may appoint a valuation officer. And remember one thing. Suppose I had already argued in front of the stamp duty officer at the time of registration of the property, suppose I already went and made an argument there, then I cannot go and make an appeal to the assessing officer today because I already argued there. But if I have not argued earlier, then I can go and make an application to the assessing officer and the assessing officer will appoint the valuation officer. The valuation officer will go and look into the facts and circumstances of the scenario and he will give a valuation report based on which the assessing officer will complete the assessment. Simple and straightforward. What if advance money received is less than 50,000? Absolutely. Even if it is less than 50,000, it will still be taxed under 5629. There is no benchmark figure of 50,000 there. 56 to 10 is applicable in case of gift. So don't confuse gift ka limit with 56 to 9 ka limit. Deepak, don't worry. Please understand the intention of legislature is quite simple. Don't become sentimental and say the SSC is paying more. No, sir, he is not received that consideration. Why is he asked to pay tax on the stamp duty value? Remember, let us say there's a property in Jubilee Hills which is 5 crores and the SSC sold it for 2 crores. Department is asking him to pay tax on 5 crores. What is wrong in that? He has sold it for less than stamp duty value. And if he feels that the stamp duty value should be lesser, if he feels that the stamp duty value is greater than the fair market value, then he can go to the assessing officer and ask for valuation officer to be appointed and he can ask for the valuation report. Next, as far as deductions are concerned, now I would like to make a specific emphasis on 54EC here. Why? See, earlier, prior to Finance Act 2018, 54EC was one of those sections that as chartered accountants, we used to advise to anybody and everybody. Matlab, one person sold jewelry, what to do? I don't want to pay tax, 54EC. One person sold land, what to do? I don't want to pay so much tax, 54EC. Any asset sold, we used to tell them, go and please invest into bonds of NHAI, that is National Highway Authority of India, or RECL, Rural Electrification Corporation Limited. But now, after 2018, remember, this benefit of 54EC is applicable only for the transfer when the transfer is of land and or building. If the asset transferred is land or building, then only 54EC is eligible. That 50 lakhs ka limit hai na, 6 months you have to invest. Only if the asset transferred is land or building, So whenever you want to give this exemption under 54 EC, check if the asset transferred is land or building. As far as Section 54 is concerned, quite simple and straightforward. You are transferring a residential house property, you are reinvesting in other residential house property. What is the time limit? For acquisition, it is 2 years from the date of transfer or 1 year prior to the date of transfer. For construction, you could have started anytime, but the amount should have been invested within a period of 3 years from the date of transfer. What if the amount could not be spent on or before the due date of filing of return? You have to deposit into a capital gains account scheme on or before the due date. 54F, what is the difference between 54 and 54F? Lot of you get confused here. 54 is when you are transferring a residential house property and you are acquiring another residential house property. 54F, you are transferring a long-term capital asset other than residential house property and you are investing into a residential house property. Remember, both of these 54 and 54F are applicable only for individual and HUF. Any other questions? Now, let's see what else is left. Okay, one of you wanted me to discuss what is the taxation aspect. Now, something which I have emphasized a lot in my video classes, and I'm going to repeat this again. Listen to me carefully, because most of the questions that you will get, they will ask you to find out the tax thereon. And I want you to follow very simple things. First, find out your gross total income. Now, once you find out your gross total income, please remember, we have to bifurcate all those incomes that are being taxed at a special rate under capital gains. Under capital gains, we have only 3 sections: 111A, 112, 112A. So whatever was included into gross total income under these 3 sections, you put it aside. So if capital gains had long-term capital gains, so we know it is 112. Take that, put it aside. 112, 10 lakhs. Baki ka, you put it separately, called residual income. Remember, from gross total income, first you separate those incomes under capital gains which are being taxed at special rate, and then remaining you call as residual income. Now, what is the tax rate for this? 111A, 112, 112A, you know the rates are 15%, 20%, 10%. And in case of 112 proviso, you know, in case of listed securities, you can either pay with indexation 20% or without indexation 10%. Correct? Now, in the residual, you again have to bifurcate those incomes which are taxed at special rate, and for C intermediate level, the only thing that's there is the income from lottery, which has to be taxed at a special rate of 30%. So take out that also, put remaining as other. Now, someone was asking me what is that basic exemption limit that I'm going to teach you now. Let us say gross total income is 4 lakhs. And out of this, 112 is 2 lakhs, other is 2 lakhs. Now, what is the basic exemption limit of the SSC? The basic exemption limit of the SSC is 2.5 lakhs. So, in the other, once you reduce 2.5 lakhs, there is still unutilized basic exemption limit of 50,000. Yes or no? There is unutilized basic exemption limit of 50,000. This unutilized basic exemption limit can be used against the 2 lakhs if the SSC is a resident individual or a resident Hindu undivided family. Understood? So let us say the SSC is a resident individual. This 50,000 which is left, he can use it against LTCG, long-term capital gains under 112. So therefore 2 lakhs minus the 50,000, then 1,50,000 will be taxed at 20%. Only 30,000 is the basic tax. Suppose this SSC is a non-resident, then this unutilized basic exemption limit is gone, wasted. And this entire 2 lakhs is taxed at 20%. Therefore, 40,000 is the tax. Now going forward, anything else? Sir, capital gains for security, please revise one time, sir, please. Capital gain for security. What do you mean by capital gain for security? Sir, please discuss the sections to give more important like. Now, in the IPCC exam, the major thing they test you is computation. So they will give you a scenario. They will see whether you know how to take the sale consideration, how to identify expenses on transfer, net sale consideration, cost of acquisition. Remember, cost of acquisition. What are the sections you've learned? You've learned section 55, subsection 2. You've learned section 49. Correct. They will see if you're taking the fair market value as on 1 for 2001 or the original cost of acquisition. They will see in special those 8 assets where the cost of acquisition has been taken as 0. Correct. Why section 112 no indexation benefit? Even though long term, please let us know logic. I'm not here to discuss logics, please. That I've already discussed in the video itself, and some when we have enough time, we'll discuss that, but not today. What about MCQs case based in tax? There are a lot of MCQs that are already given in the app itself. Go to the app, answer the MCQs. They will help you a lot. Anything else? Sir, what is the due date for deposit in capital gains account? The due date is the due date given under section 139 subsection 1. For example, for a person like me, due date will be 30th September. For a, you know what I mean. Please type in your questions if you have any. 194M and N are applicable for this attempt, of course, yes. How income from speculation in securities is determined and taxed with reference to intraday trading and delivery-based trading. A very important question. Now, let us understand this. Now, Guru, and to understand the answer to this question, first of all, you must know what is a speculative transaction. Correct? So, why am I asking you this? Now, speculative transaction is a transaction wherein wherein the transaction is settled by a mode other than by way of delivery. So when you talk about intraday, it is definitely a speculative transaction. Now, if this speculative transaction is your regular business, then it is a speculative business. For example, if doing intraday is your business, then what you are doing is a business. What you're doing is speculative business. And remember, whatever is the profit or loss from this intraday, you have to separately compute. It's given very clearly in section 28, which is the charging section for PGBP. You have to separately compute what is the business profit or business loss from this speculative business transaction. And remember, the loss from speculative business can be set off only against the profits of speculative business. Now, if it is your business, if it is not your business, then what to do? Now, for example, for a person like me, I really don't invest into the stock markets, nor I even trade on a daily basis. But suppose my friend comes to me and says, "Boss, Yes Bank is fallen, and what falls will always go up." This is what my friend told me that particular day. So what I did, I bought 1 lakh shares of Yes Bank for, let's say, 12 rupees. On the very same day, let us say that stock went up to 20, 25 rupees, double the money. I thought, oh, how I cannot make more money than this. So that 12 lakh worth of stock, I sold it for 24 lakh. Wow. It's a short-term capital gain. It's definitely speculative. But in capital gains, we don't bifurcate between speculative and non-speculative. Remember, this bifurcation is only for the purpose of business income, not for the purpose of capital gains. So as far as if it is if it is not my stock in trade, it is a capital gain for me, then on that I will pay tax as per 111A, 15% of that 12 lakhs. Am I clear, Guru? I hope I'm clear. Can you explain about SIT? What is SIT? Stock in trade. Oh, what do you want? Now, what is stock in trade? It's a question that you must ask your accounts faculty, but let me see if I can explain it to you. Now, any activity that is done by an SSE has to be looked at from various angles to determine whether or not that activity is business in nature. And of course, it will also determine whether that asset that is holding is stock in trade or not. Let us say I have a remote, I have air conditioners, I have a couple of them in my house. Uh, this air conditioners, is it a stock in trade for me? No, not necessarily. Why? I have no intention to do business with them. So it's all upon the intention. And various courts have also held. I can specify one case, in the case of Rajini, where the court very clearly said, one, the assessing officer must not look from a single angle. He must look at different things, like does the SSC do this transaction regularly, continuously, periodically, amount invested, how, from where is the capital borrowed, invested, is it own funds, is it surplus funds, is it savings, is it family funds invested. So all these are also taken into consideration to determine whether the asset is capital gain or not. Definitely, I bless all of you. So I hope all of you do good. You can ask me any other doubts you have. Thank you for all the good words. Any other questions that you guys have? Yeah, we'll see if we can do a session like this for PGPP. Please explain Section 50 CA. Okay, as far as Section 50 CA is concerned, let me first of all explain Section 50 CA for what is it applicable. Now remember, Section 50 C is for immovable property, and you know the concept. The concept is that when an immovable property is sold, you are comparing the sale consideration with the stamp duty value. So similar concept is for section the quoted securities, or other than quoted securities, I must say. So he says, where the sale consideration received or accruing as a result of transfer by an SSE of a capital asset being share of a company other than quoted share is less than the fair market value of such share, determined in such manner as may be prescribed, the value so determined shall for the purpose of section 48 be treated as the full value of consideration received or accruing as a result of such transfer. So, like how Section 50C is for immovable property, Section 50CA is for unquoted securities. What is equity-oriented mutual fund? Equity-oriented mutual fund is a mutual fund in which more than 65% of the fund corpus is invested into equity. Important tips for May 2020. Beta, study hard. Try to cover entire portion. Watch the videos carefully. uh, I don't really want to give you tips like other lecturers saying this is important or that is important. Everything is important. I think I have covered everything that is important. And one thing I strongly believe in taxation is that you don't need to by heart taxation, but you definitely need to understand how the or what is the intention of legislature. Even if you are not able to replicate the law, you must be able to put down or pen down the provisions of the law, and for that it only needs more and more listening, more and more learning on a daily basis. Do a lot of problems. That's my only advice to you. For equity shares, STT must be paid on acquisition and transfer, but for equity oriented units or units of business trust, Dilip, I don't understand why that topic has come here. presentation tips. Now, Deepak, I always say whenever you read the question, first identify what they have asked you. So if they've asked you to compute total income, clearly indicate computation of total income. If they ask you saying and tax thereon, do not write a lot of stuff in a particular table. Make as many working notes as possible. Be legitimate. I don't say you should have a beautiful handwriting, because all of you know how I write, and if I could get in at least in taxation in my final 90s, in accounts I got 94, whatever, if I could get 90s based on my handwriting, everyone can get, remember, you must be legible. It need not be neat, it need not be beautiful, it must be legible, understandable, and that's what is very important. In case of capital asset transferred as gift, what should we consider period of holding of previous owner as well as compute? Yes, please. I've already discussed Manjula J. Shah case law. In case the asset is transferred as a gift, then the period of holding includes the period of holding of the previous owner. In section number add marks. If I was an examiner, I really will not give extra marks for a section number, but I will definitely give marks if the section has been used appropriately and the section has been described appropriately. For example, if a student writes as per section 50C, the stamp duty value should be taken as the sale consideration, then I will give full marks. Did you quote section numbers in your exams? Of course, I quoted section numbers in my exams, but only in my CA final. I did not quote in my IPCC, and I don't believe section numbers had to be by-hearted. And I think I am from a family of chartered accountants. I'm the 63rd chartered accountant in my family. So we discuss sections in the house, and it's dining table discussion. So for me, sections come quite naturally, and that must be the way it is for everybody. Can we expect any case laws in MCQs? Can we accept? Can we? Okay. Not really. I don't think the institute is trying to test your memory levels. They're trying to test your knowledge. Tax rates in 112. 20% is general tax rate, and special proviso where for listed securities 10% without indexation, 20% with indexation. Deduction is allowed in long-term capital gains. Of course, deductions are allowed in long-term capital gains. Sir, will we be given full marks in theory section? Absolutely. You will be given full marks in your theory if you write what is intended. 55 subsection 2 clause AC. Let me look at it. What exactly do you want? Hey, looks like it vanished. What exactly do you want here? Grandfathering provisions. Okay, let me explain. Okay, so as far as section 55 subsection 2 clause AC is concerned regarding the grandfathering provisions, let me first tell you what was the intention of legislature so that you understand. So 31st January 2018, first let's put this date aside, and first what happened after this date. In 2018, in February, 1st February, when the finance minister had announced that from that date, the long-term capital gains arising on equity shares will no more be exempt. There was a shock. Acha, what is the law now? 10% was applied. Acha, so think about it. Till 31st January 2018, there existed a law which said that the long-term capital gains is exempt. And from 1st of February, thanks to the finance minister, there was a rate of 10% applicable. So let us say I had one share of Reliance Industries, and let us say I bought it for 1,000 rupees a share. And on 31st January, the rate of that one share was 1,500 rupees, and I held it for more than a year. Had I sold it on 31st January, there would not have been 1 rupee tax. Do you understand? But let us say, thanks to the finance minister, I sold it in the month of February for 1,600 rupees. Oh, had I sold it for 1,500 on 31st Jan, no tax. If I sell it for 1,600 in the month of February or March, whenever it is after the finance minister announced this, what is the tax statement? The tax statement is quite simple. The 1,600 rupees minus 1,500 rupees. That 100 rupees, that will be subject to the tax rate of 10%. That 1,500 rupees is very important. Why? Because as on 31st of March 2008, as of 31st of Jan 2018, 1,500 rupees was the rate. So up to 1,500 rupees, it's tax free. Correct? So they didn't want to bifurcate between those who sold it prior to the finance bill announcement and those who sold it later on. So that's the whole concept of section 55 subsection 2 clause AC. Can we expect questions from previous exam papers? Of course. What is wrong in expecting questions from previous exam? They are going to ask you computation of capital gains. They are going to ask you as far as taxation is concerned, very simple and straightforward questions. Many questions are repeated year on year. Fanindra, please refer to the video. I don't have so much time right now. If I bought 5,000 equity shares on 1/4/2007, what will happen? The company got delisted today. If it gets delisted today, at the time of transfer, they will be treated like unlisted shares. Sir, is it enough that we provide? Don't worry, IPC's level, they don't expect you to remember the notifications. Whether before indexation or after. Madhu, it is before indexation, and I have already explained this fact. Of course, this is what is followed by the ICAI also. There are a few authors who do it after indexation, but I would not want to be on their side when it comes to ICAI. So please discuss section 111 Section 111 is for specified securities, short term, sale of equity shares or units of equity oriented fund where securities transaction tax has been paid. The rate of tax is 15%. And 112 is for all long-term capital gains. The general rate is 20%. And for the proviso, that is listed securities, you have an option 10% and 20%. 10% without indexation, 10%, 20% with indexation. Surendra, Suraj, we have a lot of MCQs that have already been put in the app. So I think I'll end it with this. And I think it's 4:30 now. In a half an hour, our Prime Minister has asked us to do something very important. So let's get to it. And before that, don't forget, enjoy learning. And if you have any doubts, you can please post them to Indigo Learn. And enjoy your learning at Indigo Learn. Watch more videos, share with your friends, discuss, solve more MCQs, look at revision test papers. This is all that This is all that I can tell you. Yes, is there anything you want to tell me, sir? Joint development agreement concept. Okay, joint development. This is the last question I'm going to answer. Okay, what is joint development agreement? Again, very simply, because people who are into real estate understand this. People who are not might not understand it. Let us say there is a landowner and there is a builder. If the landowner is contributing his land, the builder is contributing his construction services, and the builder is making a building, half of which goes, it could be half, it could be whatever, some percentage is going to the landowner and some percentage is going to the builder. This contract is called as a joint development agreement, specified agreement for which taxation has been given under section 45 subsection 5A. Is that all? Okay, thank you guys, and hope to see you in the times to come. So study hard and all the best for your exams. Bye.